to you about the American economy over the last 20th century. So we get started here. A little bit about the 20th century. So it was full of a lot of economic downcline, and a lot of it followed historical wars that happened. And it was also a mark of what started a lot of greed that happened in the communities, or in the economy rather, in businesses that also resulted in some failed businesses as well. So in 1900 and 1907, the beginning of that was the panic of 1907. This was a start when the stock exchange fell about 50% from the previous year. It also was a start of some of the political, or some of the greed, I guess you can say, that started with some companies. Knickerbocker Trust Fund was a company that had a huge amount of money that was invested in them. They also tried to corner the market. So if you know what corner the market is, they wanted to take, between them and two other bankers, they were going to try to take all the shares of the copper company. When that failed, people panicked and they start withdrawing money. And there were lines and lines of people withdrawing their money saying, we're fearful now of what's going to happen. It resulted in a huge collapse in the banks, which meant that everything was at a standstill. Knickerbocker had to actually close their doors because there were so many people trying to withdraw money. It was over $8 million that got withdrawn. If you know, back in 1907, that was a lot of money. And that, after the panic, you also had the big earthquake in San Francisco. It was a 7.8 magnitude earthquake. About 2/3 of the city was devastated. People were homeless. There was over 200,000 people that didn't have a place to live. And then also San Francisco at the time was the site of the U.S. Midwestern branch that was located there. So this was our corner market for the economy, was situated here in San Francisco. The damage from that earthquake resulted in a lot of insurance companies failing, because obviously they were paying out a lot of claims, which they weren't prepared for at that time. It also had an impact on the New York Stock Exchange as well as the London Stock Exchange. And it was also, at the time, we were also on the gold reserve, or the gold standard. So that a crash obviously had an impact on our economy. As we look also in 1907 as well, the Westinghouse Electric Company, which was one of the bigger electric companies at that time, it also failed. Their stock prices continued to plummet. Company that you may hear of still today is JP Morgan. JP Morgan came in and helped to relieve or help assist in this matter. They cornered and started getting bankers, as top bankers, as well as stock people, and saying, okay, we need to help the economy. And so they organized with some of the bankers who had money, who hadn't got depleted at the time. They organized for them to come together and help out the banks that were failing, to obviously help our economy overall. 1911 to 1920. In 1913, we had unemployment that rose up to 7.9% based on the recession that was happening. This was also pivotal because our Federal Reserve System was created at this time. The Federal Reserve System created banks that said that we are now making sure that all of our money is not held in one bank like it was with Knickerbocker Trust. It was important to say that how can we ensure that we don't have a repeat of 1907 where banks are collapsing based on people withdrawing their money, and then how are the banks going to recover from any economic situation? 1914 is known as the forgotten financial panic. Part of the reasons when you look in your textbooks, you may see very little about it. This, though, was also pivotal because it was right after, or right around when World War I broke out in Europe. And as I mentioned earlier, you'll find that a lot of the economic downfalls came right before, right after one of the wars. And so in this time, when the war broke out, stock markets start closing. There were some stock markets that closed for 6 weeks and some that were closed for over a year. And again, with the time period, we had on the gold standard, money was exchanged more freely than it is now. So with even going over to different economies or currencies, since we all were on the same type of standard of exchange, when one bank failed or when the stock market closed, everyone got stagnant. Everyone got stopped in a place and could not trade. They tried trading a little bit off the books until they found out that the rates were not what they needed to be, or they were not accurate. Post-World War I, there was a recession from 1918 to 1919. This is as the war began to decline, and as it declined, so is the U.S. economy. If you're familiar with how the wars work, when there's a war going on, we send people out to war, we start having more production because we're producing different things. War declines, that means people come home, the troops are home, and then they're looking for work. and then also the production declines. So there goes why we start to get into this recession. 1920 to 1930 was probably the bigger years, but actually goes up into probably about 1939, actually, that are the largest time period of our depression. So the depression started between 1920 and 1921. This is right after World War I ended, and this is often called our forgotten depression. It kind of was a short in comparison but it also preceded the 1930 depression. It was also the most deflationary year in American financial history. Unemployment reached up to 12%, and the Dow dropped another 50%. And our reserves Federal Reserve doubled interest rates to 7%, so from the previous 3.5% up to 7%. And then it led into the Great Depression. Now, this is one of the longer depressions we have in our history. It's a 10 years span here. It was our worst economic slump. You see, unemployment reached up to 24, almost 25%. And this was also a time when Roosevelt started trying to produce this is New Deal. So is anybody familiar with the New Deal? A little bit? Okay. So in an effort to try to see how we balance out our economy, this is when you start seeing huge spikes in between unemployment and interest rates, thinking that if we raise interest rates, which also increases our inflation, if we start raising the interest rate and our inflation, would that help us with our unemployment? And this was kind of a back and forth that happened over the course of several years. Also in 1929 is what we call Black Tuesday. This is when the stock market crashed and businesses went under, and that's when our unemployment started rising there. One other thing to note about 1929 to 1939 is that the New Deal had such an impact that we'll see when we get into 1974 here, 73 to 75.